Okay, I want to show you something that should be impossible. So right now the price of oil is well above what our national budget assumed it would be. 25 to 30% above. For an oil and gas nation, that's supposed to be a windfall. The kind of luck that fills the treasury, grows the savings fund, and shrinks the deficit. And yet, as of this recording, the government has just announced it needs almost $3 billion more than it budgeted just to get through the year. Now sit with that. Oil is up, and the country still can't pay its bills. This isn't a story about who's in office. It's happened under both sides, under every government we've had, through boom after boom. It's a story about the ground we're all standing on and why that ground is a lot less solid than the national conversation pretends. Because if a windfall can't save a country, you need to ask the harder question: what's holding up your money? The savings, the pension, the safe local investments you're told to trust. That's what this and the next few weeks are about. I'm Tyrone, and this is the Caribbean Capitalist. Okay, so let me lay out the paradox plainly with the numbers as they stand. The national budget was built assuming oil at about $73 US per barrel. Now, as of this recording, oil spiked to around $117 back in April, the highest since 2008. And even after easing back toward the low 90s on ceasefire hopes, it's still more than 25% above what our budget assumed. So, by the government's own arithmetic, that should mean billions in extra revenue, a surplus, breathing room. Instead, the government has announced it needs an additional $2.93 billion in supplementary funding just to finish the fiscal year. So, how does a country get a once in a decade windfall and still come up billions short? Two reasons. One is about what we produce, and the other is about what we spend. And both of these are bigger than any single government. So here's the first reason, and this is the one nobody wants to say out loud. We're not the energy power we think we are, at least not anymore. The country's own energy chamber lays it out. At our peak around 2005, we produced about 150,000 barrels of oil a day. Today, production is down roughly two-thirds from that peak. Not down a little, down about 67%. Gas tells the same story. About 2009, we produced about 4.5 billion cubic feet of gas a day. Today, it's roughly 2.3, roughly half. So when the windfall came, we had the high prices, but not the barrels. High prices on collapsed production still leaves you short. And it gets sharper. We don't even refine our own fuel anymore. The refinery closed years ago. So an oil nation now imports refined gasoline and diesel. So when oil prices rise, we earn a little more selling crude, but we also pay more for the fuel we import and subsidize. The windfall partly cancels itself out. And our great hope for reversing the gas decline, it depends on gas piped from across the border, from Venezuelan territory, on a timeline that keeps slipping and a foreign license that has to keep being renewed. An energy nation planning to import energy. This isn't a political talking point. It's the energy chamber's own data and the industry's own numbers. The production base that's supposed to underwrite everything. The pension promises, the subsidies, the peg, has been shrinking for 20 years under every administration we've had. So that's the production side. Here's the spending side. And I want to be scrupulously fair about this. Of the nearly 3 billion the government is asking for, the overwhelming majority, about $2.83 billion, is recurrent spending, wages and salary increases for roughly 62,000 workers. Now, whether you think those raises are deserved or not, and many of those 62,000 people work hard and absolutely deserve a raise, the structural point doesn't change, and that is this: a wage increase is permanent. It's a cost you'll carry year after year forever. But the oil windfall, paying for that this year, is temporary. It exists because a war on the other side of the world that will eventually end. When you fund a permanent cost with temporary money, you're not solving a problem, you're scheduling a bigger one. And again, this isn't about one party. Successive governments through boom after boom have done the exact same thing. Spend the windfall on things that don't end and left the bill for when the windfall does. So put the two halves together: a production base that's collapsed by two-thirds, a spending base locked into permanent commitments, and a windfall that is temporary by nature. That's not a scandal you can pin on a name, that's structure. And here's the part that matters for you. No government, not this one, not the last one, not the next one, can spend its way out of a structural position this exposed. The independent economists are saying it. The Chamber of Commerce has been saying this for years. The country's own energy industry is saying it. This isn't opposition noise. It's the people whose job it is to read the numbers all reaching the same conclusion. The window to fix it is the windfall itself. And windfalls close. When this one does, The warnings from the independent economists are blunt. Part that's left runs toward credit downgrades, deeper foreign exchange shortages, and eventually painful, externally imposed adjustment. You know that last phrase by its more familiar name, the IMF. Not predicting a date, nobody honestly can. I'm telling you the direction the pressure runs. And you simply don't have to wait for the IMF to feel this. You're feeling it already. In a place every family checks the grocery. The official headline inflation number is low, under 0.5%. The kind of number that says everything is fine. But in the same official reports, food inflation is running higher, and specific staples have jumped. Flour up over 20%. The Supermarket Association itself has said people are switching away from the brands that they trust to whatever is cheaper and buying smaller quantities of it. That last part is the tell. When the official number says prices are flat, but families are quietly trading down to cheaper brands and smaller packages, that gap between the number and the kitchen is the inflation. It doesn't show up clean in the statistic. The basket is simply lighter and it costs more. So here's where it leaves you as an individual, which is the only place I can actually help you because I can't fix the national balance sheet and neither can you. If the state's own finances are disexposed, if the windfall can't save it, if the production base is shrinking and the spending is locked in, and even the grocery is quietly getting heavier, then the comfortable assumption underneath most people's financial life starts to look very shaky. That assumption is this: I'll be fine because my money is somewhere safe and local. The savings, the pension slash annuities, the local fund your advisor puts you in, the investment that's sensible because it's right here at home. All of it rests on the very ground we just watched move. So, the real question, the one I'm going to spend the next 4 weeks answering, is this: how does a Caribbean professional actually keep pace? The traditional answer is the one you've been given your whole life. Put your money in local funds, in local investments, and let it grow. It sounds responsible, it sounds safe. Now, over the next 4 part series, I'm going to show you piece by piece exactly why that traditional answer rests on some shaking ground and what the alternative actually is. There are four forces working against you. Most people never see even one of them clearly. I'm going to draw all four. It starts next week with the force working against your money every single day, whether you act or not. I'm Tyrone Archie Stewart. This is the Caribbean Capitalist. The series starts next week. If this really mattered to you, send it to one person who still thinks safe and local means safe. I'll see you in the next one. Bye bye.